There has never been a greater time than now to invest in the Metro Detroit area, and there is no other investment firm better qualified than Platinum Real Estate Holdings. With 40 years experience and over 1,000 homes sold, let Platinum Real Estate Holdings assist you with the purchase of a city-certified home of the highest quality, turnkey properties, screen renters, yielding instant cash flow. Well, what are you waiting for? Call or visit us online today.
Welcome to the weekly recap for the week of June 20th. In today's recap, we're going to talk about current home prices in the metropolitan Detroit area. We're also going to talk about why interest rates are expected to hold steady. And lastly, why Michigan's jobless rate has dropped. This week's recap begins now. The Metro Detroit area housing market hits new heights. The median sale price of homes and condominiums in Metro Detroit hit an 8-year high of $165,000 in May, according to data by Farmington Hills-based RealComp2 Ltd. As prices steadily climb, the inventory remains far below pre-recession levels. The result is that home buyers often find themselves in bidding wars over property, said Patrick Carolyn, a realtor with Coldwell Banker Weir Manuel in Birmingham. The region's median sale price of $165,000 hasn't been that high since at least January 2009, according to RealComp, for the region of Wayne, Oakland, Macomb, and Livingston counties. At the bleakest point of the mortgage crisis, when foreclosures flooded the market with 39,500 properties for sale, Metro Detroit's median price sank to $38,000 in March 2009, according to RealComp. The inventory of desirable homes for several years has been scarce. Last month, there were a little over 13,000 properties for sale, a 17.1% drop from May 2015. Looking at individual median home prices for May 2016, Oakland County's May median price was $208,000. Macomb County's May median price was $140,000. Wayne County's May median price was $118,000. And finally, Livingston County's May median price was a little over $216,000, all up from 2015. Inventory remains low for a number of reasons. Number one, the number of new homes built in Southeast Michigan since the Great Recession has been far below the 40-year average of about 10,000 new housing permits a year, says the Home Builders Association of Southeast Michigan. Secondly, another reason for low inventory is that many current homeowners will lose money if they sell. Data shows that about 21% of Metro Detroit homeowners are underwater, meaning the amount owed on their mortgages is higher than the value of their home. And third, in Detroit, most sales are made in cash because the ability to get a mortgage is limited. Americans are concerned about this widening inequality of wealth, Lawrence Young, chief economist of the National Association of Realtors, said. One of the contributors is that the home ownership rate is at a 50-year low. Fewer people are participating in home ownership, particularly among the younger generation, and that's tied to student debt, at least the survey says. Even Detroit Mayor Duggan said earlier this year only 500 mortgages were granted out of 3,000 homes sold in Detroit last year. Duggan said the reason has nothing to do with credit scores and income. It is 100% a problem with appraisals. Here's some good news. Earlier this year, Detroit launched a $40 million program that aims to create 1,000 new home mortgages in the city. With Detroit Home Mortgage, qualifying buyers will get a first mortgage for the appraised value of the home and a second mortgage up to $75,000 to fill the gap between the appraised value and the sale price and/or the cost of renovations. The website is DetroitHomeMortgage.org. Again, that website is DetroitHomeMortgage.org. Appraisals are often much lower than the sale price, and that gap kills any chance of buyers to get a mortgage without increasing the size of their down payment. Federal law doesn't allow banks to approve mortgages much higher than the appraised value of a home. Next up, what's the verdict on interest rates? Well, the Fed will leave the rates unchanged, and there is no hint on timing of a hike. The Federal Reserve signaled Wednesday it foresees an exceedingly slow pace of interest rate hikes ahead, and is in no hurry to resume them. In explaining its decision to keep interest rates unchanged, the Fed expressed concern about a recent slump in U.S. job growth and about the potential consequences of Britain's vote next week on whether to leave the European Union. The Fed suggested in a statement after its latest policy meeting that it needs a clearer economic picture before resuming rate hikes it began in December. It did note the housing market is improving and that the consequences of an export slowdown have lessened. Yet, it signaled concern about the uncertainty of employment growth and global developments. The Fed wants to make sure the surprisingly weak payroll number for May is a temporary phenomenon and not a harbinger of a weaker economy to come. In addition to the May jobs report, other economic barometers have also sowed doubts, from tepid consumer spending and business investment to a slowdown in worker productivity, to stresses from China and other major economies, and inflation remains below the Fed's target. The officials sounded a slightly more downbeat note about the economy's growth this year and next compared to their forecast 3 months ago. They now expected just 2% growth both this year and next year, down from their previous forecast of 2.2% for this year and 2.1% for 2017. In May, the government caught the financial world off guard when it said employers added just 38,000 jobs in May, the weakest gain in 5 years, and that job growth averaged just 116,000 the past 3 months, down 230,000 for the 12 months ending in April. Some economists do think a July rate increase remains possible. Others say the Fed's economic outlook will still be too cloudy next month and are pointing to September as the most likely time for a Fed move. And lastly, the Michigan jobless rate drops to 4.7% as hiring stalls. Michigan's statewide unemployment rate dipped by 0.1 of a percentage point during May, but not because more people found work. The rate of 4.7% came about because 6,000 men and women quit looking for work, according to data released Wednesday by the Michigan Department of Technology, Management, and Budget. While the total number of unemployed workers and the size of the state labor force dropped, the total of workers with jobs remained flat. The May data shows the first drop in Michigan's labor force since June 2015, and the first time this year that the state's total employed workers failed to grow. While the state unemployment average includes self-employed workers, freelancers, and independent contractors, the separate survey of employers in the state found payroll jobs dropped during May, declining by 13,000 jobs. The losers were in the manufacturing, transportation equipment, and leisure and hospitality services sector. Each lost 7,000 jobs during the month of May. There were some winners, though. The largest gain was in the addition of 3,000 jobs in the education and health services sector. The drop-off in new jobs mirrors the national employment trend, according to data from the Bureau of Labor Statistics. The national jobless rate for May also hit 4.7%. The new jobless rate of 4.7% is nearly a full percentage point lower than Michigan's May 2015 rate of 5.5%. Well, that's this week's recap. If you found this recap interesting or helpful, or you just have something to add, please comment below. Thank you for listening, and have a great day.
This has been your weekly real estate investment news recap. Did you find this recap helpful? Please like or comment below this video to enter to win a free copy of our ebook, The Ultimate Real Estate Guide for Residential Real Estate Investments. You can also subscribe to our channel or go to our website to receive the latest in real estate news. Our website also affords you the opportunity to view our latest turnkey properties.